What is up guys, Taiki here, and in this video I'll be evaluating the business models and the tokenomics of money market tokens and why I personally do not like them as investments. So if you like the content, please like and subscribe and leave a comment in the comment section below. None of this is financial advice and I could be wrong, okay? I have nothing against the protocols I'll talk about in this video, right? I'm just merely using them as examples on why I don't like the tokenomics and why I don't think they're like good businesses in general, right? So I mean, you can hate me in the comments all you want, but just letting that be known, right? Try to approach this with an open mind. So it's going to be the agenda of the video, right? So let's get right into it. So I think the best way to illustrate my point is to, just trying to, I guess, approach it from this point where, let's try to approach them as businesses. And how do we really value businesses, right? We value businesses based off of like how much money they make. And how I guess the protocol accrues value to its token holders, right? Essentially. So I'm just going to compare money markets and DEXes and go over why money market tokens tend to do poorly, why market cap to TVL ratio is a meme, and all those fun points. So let's just go over AAVE first as the blue chip, right, in the space, and let's think about how they make money. So let's just focus on the stablecoin rates here, right? So if you deposit, right, if you lend out your USDC, right, use it as collateral, you earn 1.6%, let's say. And if you borrow USDC, you pay 3%, right? So AAVE essentially collects the delta, right, the difference. So, roughly 1.4% on $1.3 billion, right? At least for USDC, right? So that's how they make money. Also, AAVE has flash loans, right? So, I'm not going to spend too much time on this, right? But they also charge a 0.09% fee on that. And, how money markets make money, right? Most money markets, they just, collect the delta, right, between the interest rates. But, AAVE also innovates with flash loans and also cross-chain lending. So, this is a AAVE, right? $137. Market cap to TVL ratio. I mean, it's a meme, but, it's 0.16, right? I'll quickly touch on that. I think they deserve a premium over other forks, right? So AAVE forks should have a much lower market cap to TVL ratio than 0.16. From the innovation aspect, right? Gotta give AAVE a shout out. With AAVE v3, it's gonna allow for cross-chain lending and borrowing, right? So you can deposit, let's say, ETH on Avalanche and then borrow against that on the Phantom ecosystem, for example, right? So I don't know when it's gonna come out, but they're innovating on all fronts. Not only that, but there are institutions, right, that want to get into DeFi. They're not gonna use some random fork, right? They're gonna go through AAVE, right? Through AAVE Arc, it's KYC protocol, right? But AAVE, if you expect the TVL of DeFi to just go up from here, right, you should expect AAVE to be a part of that. Okay, so let's kind of go over other money markets and why I just think they're just not good. So I'm just gonna go over like the various forks, right, of AAVE and Compound or whatever. So one is Vesta Finance. It's okay, it doesn't have that much TVL, but low market cap. Geist has almost $1 billion in TVL, has a pretty low market cap. Scream has almost $1 billion in TVL but low market cap. I'll also like kind of go over like why that is, right? So we understand business models. Let's go over tokenomics because I think tokenomics are more important than business models. But I also think that understanding how these protocols make money will help you navigate these markets better and filter through all the BS and noise. So they're not like that great of businesses, right? They don't make that much money. Banks in real life do better because they can actually provide under collateralized loans, right? And they can, they can charge people like double-digit rates for credit card loans and all that. So until DeFi gets to that point of charging doing under collateralized loans and having all like different types of lending, like I guess like mortgages and whatnot, I would expect money market tokens to just not do that well, right? I guess also like under collateralized loans, applications that can do that, I think it's going to offer more use cases, and I think they'll do well, right? I know Mars on the Terra ecosystem can do smart contract lending for not only Terra ecosystem but also for the Cosmos hub. I think that's going to be important. I know Maple Finance is also working on that, so people are working on it, right? But in the meantime, these forks just will not do well, right? Let's go over the business model of DEXes. So decentralized exchanges, right? Most of them generally charge a 0.3% fee for all trades. 0.25% goes to liquidity providers and 0.05% goes to, I guess, the protocol. So, this is kind of the difference. 1.4 is like roughly 30 times higher than DEXes. But if you think about the amount of volume these DEXes do per day, you can easily see that, DEXes just make way more money. So this is Trader Joe, right? At the peak of the bull market on November 25th, they did essentially $1 billion in volume, right? Right now, I think they do like roughly $200 to $300 million. But you can kind of just see that, okay, like Trader Joe just makes more money, so they deserve a higher premium or higher valuation than like other money markets, right? It doesn't matter if a money market has $2 billion in TVL and Joe has less, but Joe just makes more money, right? It is what it is. And also DEX tokens, I think, is a way more reflexive way to play bull markets, right? Because if we enter a bullish phase, you can easily imagine a scenario where, I guess, trading volume like quadruples per day, right? Because more speculation means more trading, which means more fees. I think in the past week they're averaging like roughly like $200 million per day in volume. But if we enter like a bullish phase, it can easily go to like 600 million, right? It can easily 3x overnight. But on the money market, deposits and borrows on money markets, it's not going to 3x overnight, right? Like if AAVE has like $5 billion on AAVE, sorry, if AAVE has $5 billion in Avalanche and we enter a bullish phase, it's not like it's going to go to $15 billion. Like, it doesn't work that way. So DEXes, their tokenomics and their business model, it does better in bull markets, and even in like, slow phases, it still generates more fees, right? So Spooky Swap, right? $150 million TVL, and Joe, $175 million roughly, right? And the market cap to TVL ratio is much higher than like Geist, for example. Yeah, and I'm not taking anything away from these money market protocols. I think I think money markets, right? Trusted money markets are more important than DEXes, right? From like an ecosystem standpoint, but it doesn't mean that the tokens are good, right? And market cap to TVL ratio is a meme. At the end of the day, it's tokenomics, supply and demand. And I also want to go over yield aggregators and how they affect these money market tokens. So this is Vesta Finance, right? The blue chip. They're on Ethereum and Phantom, right? This is the Phantom side, and these rates are actually pretty good, right? Like let's say 13% on wrapped Bitcoin, right? 10% on stablecoins, 9% on ETH, right? Maybe this is somewhere you want to park your money, because I think Vesta is pretty safe. So let's dig deeper on wrapped Bitcoin, right? Because how do they generate 13%, right? Because they're not just printing that out of midair, right? They're not like Vesta isn't paying out in the Wi-Fi token. That yield is coming from somewhere. So, if you click these vaults, it'll just show you like all these strategies, but you can see that wrapped Bitcoin, the strategy is like literally folding on Scream, right? And dumping the Scream token to buy more Bitcoin, right? So if you deposit 1 Bitcoin, right, they'll deposit it into Scream, they'll borrow like 0.6 Bitcoin, redeposit 0.6 Bitcoin, borrow more Bitcoin, more, like, it's like this folding loop, right? Just keep looping it until it's like the safe amount. And you're gonna earn Scream tokens, right? And Vesta will just farm and dump it for you, right? They'll just do it for you. I mean, you can do it yourself, but Vesta is like a more hands-off approach of like letting Vesta farm and dump money market tokens for you, right? To accumulate more Bitcoin. I mean, Vesta has no ill intentions, right? Maybe they're bullish Scream, but their job, right? Their business is to offer good yields and charge a fee, right? And in a capitalistic society, these protocols, they're gonna or I guess these yield aggregators, they're just gonna farm and dump these things, right? Because it's like the most simple strategy. And also, DEX tokens have a different demand curve. So I'll kind of go over what this means. So just focusing on Trader Joe, right? If you look at the liquidity profile of the Joe token, we see that let's say $38 million of liquidity is in Joe AVAX pool, 9 million in the Joe USDC pool, 2 million, in these pools, right? Meaning that, Joe is much more liquid than Scream, for example. So I think the sum of this is like 50 million, or yeah, let's say there's like $50 million worth of liquidity in Joe and like other token pairs. So if there's $50 million of liquidity in these pairs, then that means that, someone, right, around the world had to have bought like roughly $25 million worth of Joe to provide liquidity, right? That's what it actually means, right? So there's like the buy pressure there, and DEX tokens are just more liquid, meaning that there's more demand, right? Because if it's more liquid, then that means people bought Joe to be a liquidity provider. Whereas for something like Scream, right, it's not a DEX, right? They have to pay people to provide liquidity. And the TVL of Scream FTM is 6 million, right? So $50 million, meaning that $25 million of Joe was bought. $6 million here means that only $3 million of Scream was bought. So different demand curves. different tokenomics, different business models. You can kind of see where I'm going with. Yeah, so DEX tokens are just better than money market tokens on average, right? The tokenomics, and they perform better in bullish phases for the examples I've given. So let's kind of evaluate these projects. And like I mentioned at the beginning of the video, I have nothing against these projects, right? I'm just going over them to illustrate an example. Vesta and Abracadabra, they're not really money markets, but I already kind of talked about money markets. So I kind of want to give examples of like forks and like how that kind of affects, I guess, the demand side of these tokens. And also Vesta and 100, I think they're like the most requested projects that people wanted me to talk about. So I'll just give my thoughts here. Vesta, and I think the reason people want me to talk about Vesta is because it's on Arbitrum and it's backed by a Tetra node, right? I don't know why, but like I feel like a bunch of people like they just assume that anything Tetra is in it's gonna pump. But at the end of the day, it doesn't really matter who's talking about it, who's behind it, who's backing it. Like if a token pumps, then it has to be because there are more buyers than sellers, right? And I want people to have this mentality of like not like blindly trusting individuals in this space. Even myself, right? Like the things I've talked about like this year has not done well, right? And I've lost money as well. And even though I do the research, I could be wrong, right? Like Tetra node, like we don't know why he's backing this, right? Like he might not be backing this because like he's bullish the token. He might just be backing this because he understands that like this type of protocol is needed on the Arbitrum ecosystem, right? Because Arbitrum is like not doing that well, like from like an adoption standpoint. So let's kind of go over like what Vesta does, right? And then go over like, okay, like where's the demand going to come from? Okay, so essentially you can take collateral like ETH, Rem Bitcoin, or Geom and use that as collateral and borrow a stable coin against it. Vesta stable, VST. Okay, so that's what it is. It has a low minimum collateral requirement, right? Meaning that, you can, I guess, lever up your ETH for a lot. And it's going to have a 0 interest rate, right? So it's really user friendly, right? So like the protocol isn't going to make that much money, right? But, from a user perspective, it's nice. And then, you can deposit VST into stability pools. I'm not going to go over like, how Liquidity works, but, this is a Liquidity fork, right? For those that don't know, Liquidity is an Ethereum native project. It does the same thing, right? I mean, Vesta took Liquidity and like forked it on Arbitrum. And Liquidity has $1.3 billion in TVL and, not that high of a market cap, right? I mean, you can argue that like, does Liquidity even need a token, right? Does Vesta even need a token? Well, I guess they do because they need to incentivize liquidity, but it's the token doesn't do that well, right? Tokenomics for Vesta isn't that great either, right? Roughly 40% is going to the team, and community treasury, I guess, hopefully it goes to the community, right? And not like for like funding internal projects or whatnot. So this is a Liquidity, right? Price chart, right? It just dumps, yeah, unfortunately. And I would expect Vesta to follow in this path, right? Because Vesta is a fork of Liquidity, right? So like, being like all these smart people being like backing it doesn't mean that it's gonna pump. Like it's not gonna like, it's not gonna buck the trend, right? Maybe it pumps more because of all the hype, but I think the overall trend is going to be down. It doesn't mean that the protocol is bad. It just means that hey, it is what it is, right? It is what it is, and also I guess the problem with like Liquidity too is that you also have to incentivize liquidity for the VST stablecoin on Curve, right? So not only do you have to emit these tokens to incentivize liquidity for the Vesta token, you also have to pay people to help maintain the peg on Curve, right? Which is a similar problem that Spell faced. Vesta is going to be a key building block for the Arbitrum ecosystem, right? It's going to be a very important a component of the Arbitrum ecosystem, but it doesn't mean that I want to buy that token, right? That's the point I'm making, right? Great application. I'm sure the great team, great backers, great advisors, but from an investment perspective, like I am not touching that with a 10-foot pole. Similarly, let's go over 100 Finance, right? Something that people also have keep bugging me to make videos on. I didn't really want to make a video on it, but I'll just quickly touch on it to highlight an example. So what is 100 Finance? It's a fork of Compound by the vfat.tools guy, right? I mean, I think we've all, if you're a humble farmer, we've all utilized vfat.tools, right? You can go to the website. It's a great website. And they introduced a VE model, right? So it's a compound fork with a VE model, right? There's not that much innovation in between. But I mean, VFAT tools guy, I mean, people trust them, right? So I don't think it's going to rug, right? So I think it's a quality protocol, right? So you can lock up your tokens for a month up to 4 years, and you can get a boost, right, on your yield, right? So if you buy at HND, you lock it up for 4 years, you can get higher rates paid in the HND token. But the thing is, like, does a VE model for a money market make sense, right? Because VE model for Curve makes sense because there's like fundamental reasons why like protocols want to buy CVX, right? But like, who is gonna buy HND and lock it up for 4 years, right? Let's imagine a scenario. Let's say you're a whale, right? And you want to like, you know, are you gonna buy $1 million worth of HND, lock it up for 4 years, so you can earn higher yield on your yield, so you can just farm and dump HND? Like, does that make any sense? I don't really think there's like a fundamental reason for why HND is gonna have like, you know, high demand. I could be wrong, right? But I just don't really see it. Like, where is the demand gonna come from? You know, I think what happened with VHND was that, you know, I think there was like the whole VE hype, right? I mean, it's still around, and I think that, you know, I would much rather, you know, buy HND over like Geist, for example, right? If you put a gun to my head, not that I'm gonna do either, because I think the VE model is much better than like not having it at all. However, I think people just like locked it up without fully thinking about it, and it just like convinced people that, hey, like you should lock it up for 4 years. And you know, I mean, if people do that, then like people are gonna buy it and like lock it up, and it's gonna help the sell side, right? Because less people will be able to sell. But you know, I don't really see a point. I could be wrong. I mean, feel free to let me know, right? But you know, and also like, there isn't going to be like an HND wars, right? Because like, we're like, who is fighting over HND yield, right? At least for, you know, at least for Curve, right? There's a fundamental reason, right? I mean, these protocols, they need to, you know, like buy CVX or CRV to vote for gauges for their own stablecoin or their synthetic assets, like, you know, Badger Bitcoin or something. You know, so there's like a fundamental, like for example, Frax own a bunch of CVX because, you know, Frax is a stablecoin, right? And they need to buy CVX to make sure that their stablecoin works. But, you know, from the 100 side, like, you know, I don't really see, you know, there's any demand there, right? So it's still a quality application, right? I mean, I would feel comfortable putting my money in it, right, to borrow and lend. But the token, I'm not really, I don't want to touch that. I don't want to touch that one. Lastly, Abracadabra. Not a money market per se, but I just want to highlight it because I actually think that Abracadabra has a really good business model compared to the other ones. So it's similar to MakerDAO. You can kind of think of it as like a fork of MakerDAO, not a direct fork, but, you know, a similar aspect. You know, you can take interest-bearing collateral and borrow MIM against it. Okay, so I just looked at the CVX3 pool because it has one of the highest TVL, and just focus on the right side here, right? So the beauty of Abracadabra and why I think it did really well was because, you know, it just makes more money. So Abracadabra, they take a 1% borrow fee upfront, right? I mean, think about like AAVE, they make like 1.4% per year, but Abracadabra, they take 1% upfront, right? That's a lot of money compared to like AAVE. Also, from an interest rate perspective, they charge 1.5% interest, right? So it's in line with like AAVE, for example, or I guess it's lower than AAVE, right? Because AAVE charges 3%. But, you know, what's more important is like the 1% borrow fee upfront, right? And they also collect the 4% fee. So, you know, if things tank, then, you know, Abracadabra or makes money, right? Spell stakers make money. I think the borrow fee upfront is like the most important aspect, right? Because, you know, that's like where the money is made. And you know, they also get to charge an interest rate and liquidation rate. I just think it's a better business model, and I think it's one of the reasons why it did so much, so well. You know, I know there's like a bunch of like, you know, uncertainty with like like the drama and whatnot, right? Yeah, and I mean, I don't have any exposure to this, but you know, just evaluating the business model, I think it's pretty interesting. Even MakerDAO has like, you know, 5 to 6 times more TVL, but, you know, Spell is generating, you know, like roughly almost half the fee, which is pretty interesting. Right? I have no idea what the hell's going on with like Wonderland, right? I haven't kept up with the drama after, like, you know, it happened. But, you know, if you objectively evaluate Abracadabra, it's a good product with like clear product market fit, right? It's not going to have that much like billions in TVL if the product sucks, right? Future is uncertain, but from like a business model, like tokenomics aspect, right? I think it's much better than, you know, some other things I've talked about. Okay, so let's kind of go over the conclusion. So, I'm not saying that these are bad projects, right? I'm not saying anything bad about the team. I'm just saying I'm not a fan of the tokenomics, right? If you want to buy it and like flip it, right? I think you can make money there. But, if you're expecting to like buy like an AAVE fork token, and hold it as a long-term investment, then you're going to be very disappointed. Humble farmer thesis, right? It says that money markets are the most important primitive for an ecosystem, right? And I still stand by that. However, it doesn't mean that these tokens are going to moon. Okay, that's not the point. They are necessary for ecosystems and important, but the tokens are a different. It's a different topic of conversation, right? I'm not saying. I'm just saying that like don't expect to buy like these forks tokens and like make you rich. It's not. They're not really innovating on any aspect, right? Which is fine, right? Like people fork these things to because like you just need it in an ecosystem, right? But generally, like I just don't spend too much time on money market tokens because there's also like as I don't spend too much time on them. And lastly, market cap to TVL ratio, like it doesn't tell the full story, right? Like at the end of the day, it's supply and demand, right? I can easily make a protocol, right? Make some ridiculous protocol, right? And lock up like a bunch of TVL, and like the token will be worth like $10, right? Or no, like the market cap will be worth like $10, right? But like who cares? Like what matters is like supply and demand. I'm not gonna launch a project, right? Trust me. I'm not gonna be that guy, but I'm just making a point that like market cap to TVL ratio is a meme. I would much rather invest in something with $1 billion market cap than like $1 million market cap, right? But you also have to look further than high TVL, low market cap, I buy, right? That is not how you make money in the markets. So that's the end of the video. I had to re-upload this to make some clarifying points because I think I made some errors. So I'm uploading this for the second time. But I think the takeaway that people should get out of this is, where is the demand coming from? How much money does this thing actually make? How high is the inflation? And with all those three factors taken into account, should I gain exposure, right? In crypto, right, it's impossible to be right all the time. I've been wrong all the time, right? But the goal is to, whenever you're wrong, it's to not lose that much money. But whenever you are right, you want to make a lot more money than when you are wrong. And also like there's this concept of like opportunity cost of your money, right? Like $1 in this thing is like $1 not in that thing. And also, there's the concept of opportunity cost of time, right? So I try to do research every single day. And it's easy to get bogged down in all the noise, right? I get chill things all the time. It's ridiculous. So for me personally, right, to help me navigate through all the noise, I just kind of ignore research, right, on the money market side, right? And maybe I just ignore a project that like does 100x, right? But it's fine, right? Because for every project that does do 100x, there's going to be like 500 projects that's going to be a 0, right? Or just like poor investments in general. So that's kind of how I think about it. So hopefully this video was useful. And in these types of environments, it makes sense to focus on cash flow, focus on tokenomics, because in a bull market everything goes up, but in a bear market, only the quality projects survive. So thank you guys for watching, and have fun farming out there.